said they a demand inflection point in the first quarter. They also note that online retailers of luxury furniture have actually ceased operations, and that may improve they're on the competitive front. Citi, which has a buy rating on this stock, said it's disappointing but not game-changing. The market, however, not enthused by what they saw from RH.
Yeah, there's disappointment in those shares this morning, currently down about 14%. Bloomberg, Simone Foxman, thank you so much. Meanwhile, Cameron Dawson, New Edge Wealth CIO, weighing in on markets, writing, quote, "We think the right mantra is respect the trend," but noting that the trend could change quickly if growth forecasts begin to deteriorate for 2025 EPS or 2024 GDP. I'm pleased to say that Cameron joins me now on set. It's good to see you in person.
Good to see you.
So let's talk about what respecting the trend looks like in this, because to me, that just sounds like being bullish on big tech.
It is being bullish on big tech just because that's where the momentum is, that's where the trend is so powerfully upward. To your point is that other sectors have really deteriorated. Look at industrials, materials, financials, energy, all areas that people had hoped would have that broad trade. They've given up all of their relative outperformance over the last month and a half, and you've seen a lot of absolute trend deterioration, which just means that where the momentum is, it is extraordinarily narrow, but it's hard to fight.
And so when you think about those other areas of the market, the concept that I've been turning over is whether, when we think about the performance coming back together, whether it will be a catch up for some of those other areas or a catch down for tech.
The bullish outlook would be that it would be a catch up, and we think that really relies on earnings, where we need to see earnings revisions turn better for those sectors. Relatively flat. And one of the reasons why tech has done better is because it's been one of the few areas in the market have had earnings revised higher. So it all comes down to earnings. When we think about it from an aggregate basis, we look at 2025 earnings, they do look pretty high. They're sitting at $270 a share. That's 13% earnings growth next year. So that's what we're really watching for as we go back half of the year, whether or not that earnings number starts to get revised lower.
So that's the thing to watch to the earnings picture. Let's talk about the economic picture, though, because you mentioned, of course, GDP and maybe some of those projections coming down. And you think about some of the data that we saw this week, and you could get a little bit concerned that maybe we're starting to see the beginnings of a growth rollover. Where do you fall?
Well, we have seen those economic surprises turn down pretty significantly over the last month and a half as well. Actually at their lowest level since 2022, when you were aggressively cutting GDP forecasts. GDP forecasts have been, through this last month or so, been relatively stable. So what we're watching for is to see if there's mounting evidence that growth is going to come in less than expected. As if analysts haven't revised their forecasts, next week we're watching retail sales really closely. We think that's the one to judge the jobs market. If retail sales stay strong, it means that people are likely employed, meaning we probably can that employment survey versus the weak household survey.
So retail sales, of course, very important, especially after that strangely blockbuster jobs print that we got last week. I mean, how did you take that?
There was so much statistical mess in it. You could look at the employment survey and say, we can't believe the number because of all the birth and death model. But then you could look at the household survey and say, maybe we shouldn't believe that number because all the job losses came from the 16 to 24 age range, which suggests that it's about summer jobs, timing. So we think it's somewhere in between. Your Bloomberg economist, Anna Wong, has an estimate that it's close to 100,000. She's been spot on, and I think that that's likely where we land, which is that between those numbers, close to 100,000. Importantly, that's the Fed's estimate of a neutral employment market as well, which means that there's really no pressure for them to move one way or another if we do get that 100,000. Reality.
And does it matter? I mean, I was just having this conversation with Jay Pulaski, and he made the point, like you did, that it's all about earnings here. But you think about the trajectory of monetary policy. Could that upset the apple cart?
Well, it certainly has upset the apple cart for smaller cap companies and higher leverage companies. See those earnings revisions continue to move lower. They're down in the high teens over the last year, simply as higher rates are weighing on their earnings generation capacity. For large cap companies, and mostly those mega cap tech names, higher for longer is great for them. They earn a lot more in their cash. They don't have a big increase in interest payments. So it really is a world of haves and have-nots when it comes to how Fed policy earnings.
And so good news for those big cap tech stocks. It feels like in any environment that they're to do pretty well, but who needs rate cuts? A lot of people have told me it's the small cap companies that really need some relief here. How are you feeling about that tier of the market?
Well, small cap companies have 40% of their debt that's floating rate, and they have about in aggregate 50% more debt than what we see in overall cap companies. So small caps really need rate cuts. You can see that by looking at last year's performance. Look back to November and December. Small caps rallied by 30% because the 10-year Treasury fell by basis points. So it is absolutely necessary for small caps to outperform for to be relief in rates. The big question is, why would you be getting relief in rates? Because if you're seeing rates because the economy is weakening, remember that small cap companies are also very cyclical. They have a high degree of unprofitability. Nearly 30% of small cap companies are unprofitable today. That if the economy weakens, maybe you get not just balance sheet pressure, but also income statement pressure.
When I think about small caps, I often think about them and compare them to, for example, high yield debt and some of those riskier credit components. How are you thinking about the credit market right now, of course, with this backup over the past few years that we've seen in yields?
Well, it is priced for perfection when it comes to spreads. If we look at credit spreads, they're not quite at the level of 2021 tights, but they're getting close to it. Now, overall, all are still very high because base rates are high. This is what has led demand for high yield and investment debt, even though spreads have been tight. So the question is, if you start questioning that growth outlook, do you see spreads widen out pretty materially? And I think that would be the risk for credit investors, mostly into 2025.
All right, Cameron, it's always great to speak with you, especially on a Friday. Have a great weekend when you get there. Our thanks, of course, to Cameron Dawson, New Edge Wealth CIO. Now, coming up, we'll take a look at Bank of America's latest FX and rates sentiment survey with Megan Swiber, Bank of America Director of U.S. Rate Strategy. This is Bloomberg.
Former New York Yankee business. And across my career, deal. Each week, across sports, media.
It was going to be, I'd put everything I had. You know what I'm saying?
And lessons.
Huge deal.
News now. Big moves. All next move. 24/7 on the Bloomberg.
Now, context.
Let's set your agenda.
Live every weekday at 5. At the Fed.
Policy in place. They're becoming better balanced.
decade. I think
Nobody covers the Fed.
Well, Bank of America out with its latest FX and rate sentiment survey, writing, quote, last month flagged dip buying we did not see in practice. During was sold on the back of NFP, inflation fears, and politics. Joining us now is Megan Swiber, Bank of America Director of U.S. Rate Strategy. And that is so interesting because you take a look at what long end yields have done, and they've come straight down. Yes. Why are people just not enthused about duration?
So what we see from this story from our survey, and this is, again, long-only investors. So when we're thinking about who's buying in the rates market, you can still see very notable inflows into fixed income funds. That's a key here in terms of who's buying in the rates market. But what we see from this survey is that investors are just taking on a much neutral stance on duration. Just not a lot of confidence here, which makes sense, especially when we look at this context of the huge rate move that we've observed in this past week. Maybe a bit of a feeling of the market having motion sickness given the huge trading range that we've seen in the 10-year yield.
And so what are you telling your clients, for example, though, when it comes to how they should be thinking about duration? They're neutral right now, but we're at, 4.2% on the 10-year. I remember when we were not too long ago, close to 5%.
Exactly. So it's just been this huge rate move, Katie. And our story on duration, how we've been advising clients, really hasn't changed much since the start of the year. Looking to trade this range between 4 and 450. Looking to add duration when we're closer to that 5% level, above 450, and when we're at the bottom of that range. We are exactly at our forecasts for Q2 on 10-year yield, so not a strong amount of conviction and direction. But what we've seen from rates markets over the past week is really the sentiment of inflation coming back down, disinflation, which is so important for the bond market. When the bond market's not worried about upside inflation risk anymore, this does encourage a lot of of rates. And we usually see that rates protect you in these risk-off environments that we're seeing play out in global rates this morning.
Well, you think about what we're all competing with, and that's cash. And that's cash yields at 5%. And I hear what you're saying about that buffer from duration, but cash also looks pretty good.
That's exactly right, Katie. And so what we've been observing is a lot of that investor demand coming into the U.S. rates market, more of that concentrated likely in the front end and belly of the curve. Back end, we've seen that demand picture a little bit challenged. We see a lot of the pension and insurance companies that want to be taking advantage of these high rate levels. But it's a different story. But again, when we come back to the crux of how we think about rates over longer term cycles, we have the rates market trading a much higher long-run neutral rate than what the Fed is telling us in their dot plot. So there is value there if you're worried about some of these downside states of the world and downside states of the U.S. economy.
So no one necessarily wants to take it right now, but there is an opportunity when it comes to longer end of the yield curve. But this is the rates and FX sentiment survey. So let's talk a little bit about currencies here, because the dollar just feels like it's been unstoppable. How is that filtering through?
So what we're seeing is just also similarly a moderation in some of the conviction we have in FX markets as well. Consistent with the very notable swings that we've seen in U.S. rates, there's been more of this paring back of dollar longs that we had investors sitting in. Right now, I think there's actually more of this growing narrative to clients of looking at more of this dollar depreciation pressure, especially in light of a Fed that's going to cut and investors looking at rate levels and saying there may be more room for us to rally from here.
Well, I have to imagine you have to pick your spots when it comes to potential dollar depreciation. And I obviously want to talk about the yen here because it feels like nothing can really seem to stop the yen when it comes to that weakening trend.
Yeah, Katie, I would say that look at duration positioning globally. While a lot of investors are close to home and close to benchmark, and yen rates is really one area that we see investors taking on much more notable positioning. So still see year-to-date multi-year lows actually in terms of how underweight investors are JGBs versus their benchmark. So when we think about the BOJ this morning kind of reining this narrative of reducing the bond buying purchases at the back end, I think this is one factors that may be contributing to this rates rally that we see is just that very stretched short positioning we have in JGBs.
Yeah, and you take a look at where the yen is trading right now, 157 versus the dollar, just really nosebleed levels here. Let's talk about some fun stuff. Let's talk about election risk. Obviously, we got a big reminder of what that looks like when you think about India, Mexico, South Africa, and of course, France. Is there anything that investors can extrapolate from those episodes into the U.S. election?
So interestingly, when we look at the survey, we asked this question to investors: are you trading U.S. elections right now? And it seems like the resounding answer is no, we're not up to that yet. We still have to pay a lot of attention to what we're seeing in terms of global elections, and really markets looking to trade and focus on very near-term data prints. So what we're seeing, on back of the French election, a lot of the move that we're seeing this morning is concerns about what the fiscal picture looks like. Certainly that's been a concern for investors in the U.S. when we think about the extension of Trump tax cuts, what that may mean for the deficit. But largely, it's very interesting to see here, too, that this is driving more of this risk-off mentality for markets, and it's serving as more of this duration rally in U.S. rates markets, particularly. So I think it's a very conflicting signal. I think people don't have a lot of conviction in directly what this means for U.S. rates in terms of trading U.S. election, which is just another reason why people are very hesitant to trade this theme in the U.S. just yet.
Yeah, maybe it'll become more clear, of course, as we get closer to November. I have about 30 seconds left with you, but you think about the totality of this survey. What did respondents see as the biggest risk?
The biggest risk here is still a Fed that's going to be slower to cut rates on the back of inflation that remains more persistent. I think that really has been the dynamic that's been driving rates markets since the start of the year. The market got caught off guard by how sticky inflation had to be in Q1, but now we finally are seeing some of the data reflect this moderation, and so it's really the last shoe to drop for the Fed. So it's a very quickly changing narrative, even since we last ran this.
Well, Megan, it's always great to see you. Have a great weekend. Hope to speak again soon. That, of course, is Megan Swiber, Bank of America, Director of U.S. Rate Strategy. Now, let's get some of the sector price action this morning. We're going to do that with Bloomberg's Abigail Doolittle.
We're still looking at a small decline for the S&P 500 right now, Katie, down about 0.3%. Most of the sectors are lower, so it's a broad-based decline. Industrial is leading the move to the downside, down 1.3%. By materials, financials, energy. To the upside, communication services up a modest 0.4%, and then tech up about 0.2%. On the week, though, it's a much different story. Tech is up more than 6%. Its best week of the year. This is the S&P 500 climbs about 1.4%. Its second up week in a row. Not a lot of sectors are up on the week, but again, that big gain for tech, and a lot of it having to do with AI. Take a look at Bloomberg AI index up 4.2%. We also have building with rates having dropped up about 2.2%. On the downside, though, Katie, we're looking at energy sliding, and then luxury goods, speaking of that RH miss and the disappointing results there, down 3.3%. But overall, the bulls are out for a second week, Katie.
Yeah, nice even split on that screen. Abigail, thank you so much. Now, coming up, the market moving events you need to be watching. That's next in our trading story. This is Bloomberg.
Always on the
Going to be
We're going to bring you expert.
It's the key to being a really good
you can find. To have managing my
when markets are challenged. The investment hobbies are generally
report under surveillance. Jobs day like Bloomberg.
All right, let's take a quick look at this market. The S&P 500 still in the doldrums. We're down about 0.2%. I do have some good news, and that is from big tech. You can see the NASDAQ 100 made it into positive territory, up 0.2%. Can't say the same, of course, when it comes to Russell 2000 down over 1%. It's time now, though, for the trading diary. What you need to be watching today and next week. We got U.S. UMich consumer sentiment data at the top of the hour. Meanwhile, the G7 continues in Italy. On Tuesday next week, we get U.S. retail sales on Wednesday. The markets will be closed for the Juneteenth holiday. And then on Thursday, we get that BOE rate decision, of course, following the Fed. It's going to be interesting to see what they do over in England. But this was the countdown to the open, and this is Bloomberg.
We
to the Jane Goodall.
Started in station. And so some research can carry on. To study and it's developed around the world. Is at some point around chimpanzee habitat. There was crippling poverty. Being exposed to and vice versa. Living without this
more than 120. Bloomberg. Contact.
All right, we are 30 minutes into the U.S. trading day on this Friday, June 14th. Here are the top stories we're following. A win for Elon Musk. Investors vote for their CEO's $56 billion pay package and the company's move to Texas. Taking stock of the EV race as Kia accelerates its electrification strategy. We'll speak to the automaker's Chief Operating Officer, Steven Center, and placing bets on the Fed's next move. PJM sees a hike. We're going to get the view from PIMCO with Mike Kudzil. I'm Katie Greif, New York. Welcome to Bloomberg Markets. You take a look at markets on this Friday morning, and at least on the S&P 500, you're taking a little bit of a breather. Of course, we closed at another all-time high yesterday. You take a look right now, currently off by about 0.3%. Of course, we'll see how that changes as the day moves on. But let's take a look at big tech, because you're seeing a little bit of green light there. You can see the NASDAQ 100 higher by about 0.1%. Of course, it had been higher by a little bit more a few minutes, so we'll keep an eye on that. Meanwhile, the bond market rally continues to accelerate. 10-year yields currently by about 4 basis points. We could crack 4.2% in short order. Some breaking consumer sentiment data crossing the terminal right now. Bloomberg's Mike McKee has the details.
Katie, Wall Street thinks things are going pretty well, but not the American people. The University of Michigan's headline sentiment index falls to its lowest since last night for 7 months. 65.6 from 69.1, way below the 72 expected. Current conditions fall to 62.5 from 69.6, and expectations fall to 67.6 from 68.8. And Americans did not get the CPI, PPI message this week. One-year inflation expectations unchanged, 3.3%. 5-year inflation, 3.1%, up from 3.0%. Now, of course, we have Joe coming on Bloomberg, the Bloomberg terminal. If you have Bloomberg, I'll be talking to her in just a few minutes. But we'll ask what happened. Why is it that Americans suddenly turned so pessimistic in the month of...
Well, you think about psychology, you know, those feelings could start to inform their behavior. And we had this conversation yesterday. When does bad news become bad news? When should we start worrying about growth rollover? Does this slightly get us closer?
It might get us closer. What will be interesting to watch is next week's retail sales report. Did Americans pull back their spending in reaction, you know, in line with their sentiment? Feel much more pessimistic about things. The other thing is, this is, of course, the preliminary index, and we'll get an update on the University of Michigan Sentiment Index later in the month. Did the American people sense the change in inflation that the CPI and PPI reports brought about, and will they by the end of the month? Those are going to be key questions for the Fed.
Yeah, good reminder, of course, about retail sales, the health of the consumer. Front and center right now. Mike McKee, thank you so much. And of course, don't miss Mike's interview with Cleveland Fed President Loretta Mester. That's at 1:15 p.m. Eastern today. But let's turn our attention back to these markets, because joining us now, I'm pleased to say, we have Emily Rowland. She is John Hancock Investment Management Chief Investment Strategist. And Emily, it has been a huge week between the Fed and data and everything else. Has anything changed for you when it comes to your thesis and your approach to these markets right now?
It really hasn't, Katie. We continue to believe that we are in this sort of never-ending late cycle environment where the lagged impact of Fed tightening just simply hasn't tipped us to contraction yet. It was a really interesting week. I'm glad you brought up the bad news is bad news narrative. You know, on Wednesday, we got that CPI report, and yeah, inflation's coming down, but it only missed by 0.1%. It wasn't that big of a miss, but markets are so sensitive to it. You saw this massive rally across areas like small cap equities, which have been incredibly sensitive to inflation dynamics. And then the next day, the PPI report, you know, contributed to that disinflation traction, but you got initial claims jumping. And I would say that actually ended up probably being the most important data point of the week. There may have been some one-off anomalies due to the Memorial Day holiday, California claims jumping, but pretty notable here that we are seeing more signs of the labor market softening. And I think that was confirmed just a couple of minutes ago with that University of Michigan sentiment report as well. People are concerned about their jobs.
Well, that's really interesting. It's not that claims actually overshadows CPI, but maybe we saw that this week. And I mean, I'll turn to you the same question that I've been asking Mike McKee, and that's when do you start to get worried that when you think about that long lag of monetary policy that maybe the Fed went too far and growth will actually start to turn?
Yeah, well, what we're watching is this environment where, corporate revenue growth was really great during the height of the pandemic, and now it's coming back down to earth. And we're seeing companies having a harder time passing prices along. If you look into the guts of the CPI report, stuff that people want to buy, things like airfares, discretionary items, those prices are actually coming down, while the things that we need, things like medical care and shelter, those prices are going up. So companies are now having a harder time passing along higher prices, and that's going to result in margin compression. So you're going to need to see capital is much higher than it was a year or two ago, and their revenue growth is slowing. So if you're going to defend those margins, you've got to cut costs. And of course, we know the biggest cost that most companies have is labor. So the last shoe to drop in every economic cycle is that the unemployment rate shoots up. And that's what we would be watching for as a further sign that we are going to be contending with an economic contraction. It's tough to see it right now. Markets hitting new all-time highs every day. Things seem fine, but we want to repair the roof when the sun is shining. So we're leaning into higher quality assets. We're looking at income that's available in bonds right now is a great way to get paid income and get paid to wait as that contraction ultimately unfolds.
Repair the roof when the sun is shining. I'm going to write that down. I love that. But before we talk about
JFK.
That's JFK. Yeah, he had some good lines there. But in any case, we're going to get to bonds. But I want to talk a little bit about earnings because I was just having this conversation with Jay Pulaski, with Cameron Dawson, that really all that matters right now is earnings, those earnings estimates. This basically think about the Fed, and the Fed isn't going to stand in the way of this rally. I mean, when you take a look at that earnings picture, what do you see?
Yeah, I mean, one thing I would add to that conversation is just how concentrated the earnings growth has been. If you look broadly at the S&P 500 and you take out the tech and communication services sector, earnings growth has actually been negative on a year-over-year basis. So we want to look to those areas of the market that do have pricing power, stocks that have great balance sheets, lots of cash, a limited need to tap the capital markets in order to grow. That's really where we want to look to as that earnings growth becomes more and more concentrated. The tech sector is sort of the poster child for quality. We continue to embrace that area, but of course, it's got a lot of love from many investors, so it's trading expensive. We also want to look on the value side to where we can find quality at a reasonable price. So I think this is a really important time, certainly for active managers who can take advantage of those companies that are going to continue to perform, even in this environment where margins are contracting.
Well, Emily, just really quickly here, you mentioned that when you take out tech, things maybe don't look too hot. And with that in mind, I mean, can investors afford to be anything but neutral weight or overweight tech right now?
Yeah, well, we continue to have an overweight there. Again, the challenge is going to be the valuations. You look at something like the S&P 500 growth index, and it's now trading at a 45% premium to its 20-year average. So it's tough to say that tech is not overbought. We want to diversify from that. We're looking at areas like mid-cap equities, which are trading at the cheapest levels to their large-cap counterparts since the late 1990s. They're also benefiting from onshoring with an overweight to the industrial sector. So we continue to see supply chains coming back to the United States, resulting in this manufacturing renaissance, seeing particularly in the U.S. Midwest. So we're playing that through industrials in mid-cap equities, and you're not overpaying for that theme. So it's really about that balance of finding quality, but finding it at a reasonable price.
All right, Emily, so enjoyed this conversation. Sit tight for just a couple minutes. We're going to come back to you after the break, but it's time now for ETF Friday, truly the best day of the week. And this week, Bloomberg's Emily has been looking at new research by Bloomberg Intelligence about the truly confusing dichotomy of trends in the ETF market right now. Emily, what is going on?
So we'll start with performance and the juxtaposition there. This is new research from Bloomberg Intelligence. The ratio of ETFs with positive versus negative returns is at an all-time high when you look at the last 12 months. So over the last 12 months, 94% of ETFs have posted a positive return, so something above zero. But Because the S&P 500 is up nearly 25% over that time period, a record low number of funds is actually beating the index. So funds are up, but they're not outperforming. And why is that? I think it's less an ETF story and more just about, like you were talking with your prior guest, the equity market concentration in big tech. If you don't have NVIDIA, it's hard to S&P 500 right now.
Yeah, it's just a brutal period for those active managers who want to be long something other than NVIDIA. It's tough. But let's talk about something that you and I actually talk about all the time, and that's the fact that you have all of these new ETFs coming to market, but at the same time, you also have record fund closures as well.
It seems like right now it's easier than ever to launch an ETF, but it's harder than ever to succeed. I know, Katie, we talk about this a lot, but after 2019, there were regulations known in the industry as the ETF rule that essentially made it a lot easier for asset managers to launch new ETFs. And since then, you can see on that chart, we have seen really a record new listing. So in the last 12 months, 600 new ETFs, but 260 ETFs have closed as the market is getting more competitive. People are essentially launching, 12 different ETFs that all track, one single stock levered NVIDIA, and then it doesn't get enough assets and they have to close it. But because it's so easy to just launch another one, they can just try again. And so that's why we're seeing all of these launches.
There you go. And what do they say, that ETFs are sold, not bought?
Yes, exactly. You have to get your ETF in front of essentially a distribution channel, a wirehouse. If you don't have, a certain number of assets, often you are not going to be accepted onto these trading platforms, and therefore it's very difficult to gain assets and a track record. And you can see a lot of these funds closing because they just can't compete with the big three issuers, essentially, Katie.
Yeah, great context there. Of course, a fiercely competitive ETF industry. Really appreciate your reporting, as always. Our thanks to Bloomberg's Emily Grafeo. Now, we do want to bring some breaking news, and that is that the U.S. Supreme Court dealt a fresh blow to the firearm regulation effort by throwing out the federal ban on bump stocks. Those, of course, are the attachments that let a semi-automatic rifle fire at speeds rivaling a machine gun. Of course, plenty of Supreme Court decisions coming down this week. We're going to continue to keep track of them. But coming up on this program, Tesla shareholders back Elon Musk's pay package and a proposal to move the company's legal home to Texas. That conversation coming up next. This is Bloomberg.
With the big
else, Bloomberg. K decides. Foreign policy. Bloomberg. All the votes are tallied. Context change. In honor of Pride Month and in June at noon Eastern. Pride Month.
Elon Musk has won both of the votes he was facing this week. Tesla shareholders voted to approve his $56 billion pay package and the company's move to Texas. Joining us now with more is David Welch, Bloomberg's Detroit bureau chief, and we've covered the ins and outs of the vote. So tell me about the fundamentals here of Tesla in the context of an industry when it comes to EV demand isn't quite as robust as many had predicted.
Well, it's not. And one of the big questions with EV demand, particularly in the United States, is do we have an EV problem or do we have a Tesla problem? Look at first quarter registrations. Retail sales of EVs were up 9%. Now, Tesla sales have been in decline or growing very slowly, depending on what period you're looking at. Other companies are doing pretty well. And so part of this isn't the meteoric growth we had a couple years ago, generally speaking, but it's still growing. 9% at retail in the first quarter, that's pretty. Where we saw a big decline was actually in fleet, which is related to the mess over at Hertz. But Tesla's had trouble because they've got stale vehicles, same design they've had for a long time. They've got a Cybertruck that really hasn't taken off. It's really a niche product. And then you have pretty aggressive competition. Mercedes, BMW, Ford, and General Motors. They've all got new products. They're all pushing it pretty hard. And some of it's at pretty attractive prices. So, when you go from a nearly monopolistic position that had over the past couple of years to lots more competition, they're going to lose market share. And when their product hasn't been fresh in a while, then that's an issue for them as well. I think that's one of the reasons you see Elon Musk leaning on this idea that his company is an AI company. It's not a car company anymore, and whether or not he can deliver on that is crucial for Tesla because he doesn't want to be a car company. They have low stock multiples and high capital costs. He wants to continue to be seen as a giant, and he sees AI as the key. Now he's got to deliver on that.
Yeah, and of course it's a long, rocky ride there. David Welch in Detroit, really appreciate that context. Let's bring Emily Rowland of John Hancock Investment Management back into the conversation. And you think about big tech, we sort of talk about it as a monolith, but you think about the year-to-year performance, we've actually seen a ton of dispersion in those big tech names. Wondering how you're thinking about that, of course, as you think about quality names that you want to own right now.
We've definitely seen the Magnificent Seven sort of break apart here over the course of 2024. And really, Katie, we're looking at this again through the lens of quality. We want to find companies that have great return on equity. They have great balance sheets, lots of cash, very low debt burdens. And that actually brings us into the classic S&P 500 technology sector, as well as communications services. We're finding more quality companies generally across those sectors. It also leads us to an overweight to U.S. equities. You're looking at Europe, and they have a very, very small tech sector, 6% of the MSCI EPA. So if you like technology, you like mega cap tech, you want to follow earnings, you've got to look to the United States.
And how does that translate into the fixed income areas of the market, specifically corporate credit, for example?
Well, Katie, it certainly hasn't kept up with technology stocks this year. But the good news is that unlike tech, there's been a ton of value in the fixed income side. We, of course, saw this massive backup in yields over the last several years that have created this incredible entry point for fixed income investors. The fact that the aggregate bond index yielding close to 5%, investment grade corporate bonds over 5% right now. You can get paid income in high quality bonds, and you can get paid to wait. Even if we see yields chop around here, economic data continues to give us mixed messages. You're looking at the income component of bonds being a really attractive and really important component of returns. Of course, everybody loves cash. I get it. There's something else to do with short-term money right now, but you're going to be subject to reinvestment risk as rates come down, which is our forecast. Those rates are not going to be as attractive on the short end. You really want to lean into high-quality bonds here with intermediate-term duration and get paid to wait.
Yeah, I'd say, though, 5% looks pretty good. Definitely hear what you're saying, though. And, I mean, with that in mind, is it worth bothering with treasuries, or is it really the corporate market that you're seeing those opportunities?
Yeah, we are neutral treasuries, but we're overweight investment-grade corporate bonds, particularly up in the cap spectrum. You know, the fact that you can get these bonds with very low default risk and get paid and close to 5-6% income there. Investment-grade corporate bonds are trading at about 90 cents on the dollar right now. They typically trade above par, 105 to 115. So we're actually trading at one of steepest discounts right now since the global financial crisis. So we think this is a great time to unlock the value that's been created over the last couple of years in investment-grade corporate bonds.
All right. I think that's a good place to leave it. Appreciate your time on this Friday morning. Our thanks, of course, to Emily Rowland of John Hancock Investment Management. Now, we do want to go back to that breaking news crossing just a few minutes ago, and that's the U.S. Supreme Court throwing out the federal ban on bump stocks. Those are the attachments that let an automatic rifle fire at speeds rivaling a machine gun. Joining us now with more is Bloomberg Balance Power co-host Joe Matthew. And Joe, it looks like we're talking about a vote here that was largely along ideological lines.
Yeah, very much so. 6-3, not a big shock in this particular case, voiding prohibition that was actually put in place by the Trump administration. Katie, this goes back to the Las Vegas shooting in 2017. Remember that country music concert festival that was shot down upon a shooter in the Mandalay Bay? That prompted a whole debate nationwide about new gun controls. From that was this ban on bump stocks. So we're going back in time a bit on this one. It's considered a big win for the gun industry, a big win for the NRA.
All right, Bloomberg Balance of Power co-host Joe Matthew. Of course, more coverage coming up in those hours. Still ahead, though, we're going to take a look at the companies making the most social buzz today in our Social Climber segment. Up next, this is Bloomberg.
Names in business.
We're just going to have to hold companies long. Returns are going to be lower over the next few years.
We used to have high prices and have done actually
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close, weekdays at 3 p.m. only on Bloomberg Television. Context everything.
All right, it's time now for Social Climbers. The stocks making waves on social media this morning. And first up, Wells Fargo fired over a dozen employees last month after investigating claims that they were faking work. A review found that they were manipulating keyboard activity, creating an impression of active work. Now, Wells Fargo has started requiring employees to return to the office 2 years ago under a flexible hybrid model. Next up, looks set to reject a $30 billion settlement between Visa, MasterCard, and which would have capped credit card swipe fees. The federal judge suggested that she would not sign off on the deal Now, of course, retailers have long fought against fees for processing card payments, most of which go to banks for those cards. And finally, of all the hot IPOs over the past year, AI firms, startups, you name it, none have popped on Wall Street quite like Cava. The restaurant chain has soared 300% since its IPO, giving it a market valuation of over $10 billion. That equates to $33 million for each of its 323 restaurants. And of course, follow all the latest company buzz on TREN Go on your Bloomberg terminal. Take a look at markets on this Friday morning. It has been a long and it has been a busy week when it comes to, of course, monetary policy and the economic data front. And as you can see, at least S&P 500, we look set to be in the red here. Of course, this comes after a string of 4 consecutive record high closes, so maybe we're taking a little bit of a breather when it comes to your big benchmark, and down by much, 0.3%, but you know, it's still something. Meanwhile, you take a look at big tech, actually green right now, fighting to stay positive, currently up about 0.2% right now. Really, tech has been your haven in almost any market environment. Of course, that is holding true right now. NASDAQ 100 also higher by about 0.2%, also at a record high right now. You take a look at that bond market, that fierce bond rally just continuing. The 10-year yield down another 4 basis points, looking set to go below 420. We're going to continue to keep an eye on that. But Kia continues their push into electrifying their lineup. Steven Center, he is Kia America Chief Operating Officer. He joins us next. This is Bloomberg.
Make very we try to diversify, and we like to prepaid.
What have you? I mean, do you go?
Yes, we to in the public company.
Sort of circle the wagons around. Going, but we also have to be nimble. May have a buyer. They want to be an early.
Events that influence your world. Bloomberg. Contact.
Well, it's time for another special C-suite conversation. Today we're talking about EVs, we're talking about hybrids and everything else. So let's set up the conversation with Bloomberg. Matt Miller sitting to my left. It's nice to see you. Happy Friday.
It's good to see you. Happy Friday as well. I actually wore my lightning bolt tie since we're going to talk about EVs and electrification.
And batteries. I get it. The conversation around EVs, though, it has changed pretty rapidly over the past couple of years. It feels like almost everyone, including the automakers, kind of over-egged on the EV demand story.
Yeah, absolutely. Toyota, right? I mean, not all automakers. Some of them said, you know what, hybrids is still the way forward. Hedging our bets on electrification. It could be hydrogen as well. But for the most part, the entire auto industry has invested hundreds of billions of dollars in electrification. So that's not going to change, like it or not. They're not going to really make a big turn from that.
Well, we have a great guest to talk about all of this with. I'm pleased to say that joining us now is Steven Center. He is Kia America Chief Operating Officer and Executive VP. So I think you have a good sense of where we're going to start. And that, of course, is EV demand, of course. I'm curious to hear about the EV9, one of your new models. It's a 7-seat SUV, one of the big cars that Americans tend to like. What's your outlook right now? How has it been going so far?
Well, we're very excited about it. EV9 has won a couple of awards. It was a World Car of the Year. It was World EV of the Year. It was North American Car of the Year. So it says that EVs are mainstream cars. We've proven it with the design of this car, and we had the record sales last month for it as we continue to roll out the product line. It's a very exciting time.
I have to say it is. I drive cars, Steven, so I anchor a podcast as well called Hot Pursuit, and for that I test a new car each week. The EV9 is easily my favorite EV SUV. I think it's darn near perfect. The only thing I would change is, if I could, I would put a small range extender, a little motor somewhere, maybe in the front. Have you thought about that? Because it seems like that would be an improvement to almost any battery electric vehicle.
I think while you don't want to be a purist, the real answer is the evolving battery technology and the fast charging infrastructure. And that will make up for people's concerns.
But when, right, Steven? Because the problem is the charging infrastructure is dismal. Certainly where I live in Westchester, oftentimes the chargers don't work. You have to wait in line to get to one. They're really not fast, even the fast compared to filling up with gas. And that's not going to be improved in the next months or years. It's going to take a long time. So, you know, even if it's the best of the best, it still is a problem when you're on a journey and you need to find a charger.
Yeah, absolutely. And Katie was mentioning earlier, the solution going forward is probably in all of the above. While the government has been saying EVs only, we have a big line of plug-in hybrids, and that's probably the best near-term transition vehicle for consumers. You can get 30 to eventually 50 miles of pure electric range, and then you have the engine. So, depends where you are, depends what your needs are. If you're charging at home, charging at work, your EV is just fine for you right now. And that's what we're hearing from consumers.
I definitely want to get to how the government's role has played into all of this, but let's talk a little bit more about the charging infrastructure. You point out in your that starting January 2025, Kia EV owners will have access to 12,000 Tesla superchargers across North America. I think back to a couple months ago, and Elon Musk fired the entire supercharger team. Have you been in contact with anyone from Tesla about the state of basically that line of the business?
I have not directly. However, there's another opportunity, and that's Iona. I'm not sure how familiar you are with it. It's a consortium that many of the automakers have created to deploy 30,000 EV fast chargers. And you're going to see more of those type of investments in the marketplace. You shouldn't rely on one supplier for anything, and you shouldn't rely on Tesla to be the EV charging supplier.
So it's an interesting point there. It sounds like you have to diversify your charging capabilities there. It makes a ton of sense. Let's talk a little bit more about hybrids, because you think about the future, and I have to say anecdotally, I see more hybrids on the road. What do you think the future looks like? Do you think that EVs will be the dominant sort of green car, or do you think it's going to be something closer to hybrids?
It depends when, and it all depends where. Eventually, perhaps 95% of mobility will be electric, but it depends where. I always use this example that there's a cowgirl out in Wyoming somewhere with a big diesel pickup truck. She's not the problem. It's the 400,000 people with me on the highway when I'm going to work in the morning. So in urban areas, you're going to see a lot of EVs. For the term, hybrids, everything should be a hybrid. Hybrids operate when you break momentum, when you break inertia, as you start to pull away from a light, and that's the dirtiest and fuel consuming portion of your journey. So if everything was a hybrid, we'd be worlds ahead. And if you have plug-in hybrids as a tweener, you're going to save a lot more fuel and reduce the CO2 further. So it depends where, it depends when. That's the way I look at this. It's not a linear conversion to EVs.
Stephen, what's next for this market? You know, the last couple of years, the Telluride has kind of ruled the roost in terms of design for three-row SUVs. I had a couple of weeks ago a Kia Sorento, which I thought was a thrilling drive. So in terms of the dynamics, it was really incredible. Both of those, I think, you produce in your Georgia plant as well. What's next for the U.S. market?
Well, we're looking at different things on both the internal combustion side and the EV side. And what we're working on right now is building out the EV side. We want to have 7 EVs in the U.S. market by 2030 or 2027. And that's the term focus. In addition, on the internal combustion side, we're refreshing everything. So the next couple of years, the Telluride will be replaced, and we just replaced the Sorento. The Sportage that's built in Georgia. That comes in internal combustion, hybrid, and plug-in hybrid. So it's choice.
Yeah, don't replace the Sorento. It's so good. What about the warranty? You're the only company that offers such a big warranty. 10 years, I think it is, 100,000 miles. Isn't that expensive?
It is and it isn't. It sort of keeps you honest. If you have that warranty, you really got to engineer things to last that long, and that's our goal. We've been winning a lot of JD initial quality study awards and longer-term awards as well. So it's only an expense if you don't do a good job.
And Stephen, before we let you go, I am curious about what you're hearing from the dealer community. For example, what do they want right now?
It depends where. But they don't want us to abandon internal combustion, and there's some parts of the country that are very nervous about that, and we're not. We're growing. We're growing on the internal combustion side. We're selling ahead last year in a market that's pretty flat. So again, depends where you are. We're building a line of EVs, and we're improving our volume for internal combustion. We're just introducing mid-cycle refresh for K5, which is our sports sedan. So we've got a pretty good lineup. Dealers just want more of it.
Dealers just want more of it. Stephen, so interesting conversation. Our thanks, of course, to Stephen Center of Kia and Matt Miller. That was pretty interesting. It's great to see you.
Yeah, thank you very much. Yeah, very interesting. I love to follow the Kia Hyundai Genesis story. It's amazing improvement in sort of quality and acceptance from the consumer over the last 10 years. And I love to the auto industry. As you know, I co-anchor the Bloomberg Hot Pursuit podcast with Hannah Elliott.
Well, don't cut me off because I'm about to promo it. Of course,
okay.
You
Good,
can subscribe to Hot Pursuit with Miller and Hannah Elliott wherever you get your podcast.
And today we have the CEO of Ford, Jim Farley, is going to join us today. So definitely download it as soon as it goes up.
I imagine you're going to be talking about EVs, you're going to be talking about trucks and about everything
And
else.
the Mustang.
There you go. That Mach-E. All right, Matt Miller, thank you so much. Coming up, we're going to dive into the legendary partnership of Warren Buffett and Charlie Munger, two giants in finance, with Berkshire Hathaway director Ronald Olson. This is Bloomberg.
Are reshaping
the numbers.
It's not about
sheet and
Today's day, then I talk about numbers.
It's a lot more than the
more from the Chief Future this summer.
I'm Danny Berger.
This you need live every thing.
And wherever Russians normal, is this like a catalyst? I'm Francine Lacroix, and
U.S. jobs number. Expert analysis at terminals.
Across global.
Bloomberg.
All right, it's time now for Daily Wall Street Week conversation, and today we're delving into the legendary alliance forged between Warren Buffett and Charlie Munger. Berkshire Hathaway director Ronald Olson spoke with Wall Street Week's David Weston for his unique insights into the historic partnership.
Neither Warren or Charlie are typical. Did they have problems that were similar? Yes, but Warren and Charlie had the owner's attitude from day one and took a deep, deep interest in any problem. They did their own homework. They didn't believe in consultants. They didn't believe in figuring out compensation for the managers with a compensation consultant. They basically operated independent of Wall Street. So they were very different than most other clients, I would say.
Ron, talk to us about risk. I mean, risk is at the center of investment decisions. It's also an important part of a lawyer is assess risk and apprise clients of that risk. How does Warren Buffett approach risk in your experience as a lawyer?
Well, carefully. And he approaches it also often with Charlie. I mean, they would talk regularly, and particularly if you're talking about risk associated with an investment, that was a regular occurrence. And each of them approached that, I think, somewhat differently. They have a different set of priorities, a different set of reasons, a different set of life experiences. Warren is, as you know, very gregarious, out front. He's the one who cuts the deals. Charlie's sitting in his chair, as his kids say. He looks like a book with two legs, reading every day. And the two of them had this unique partnership. And it's another reason I don't have a lot of clients with a unique partnership like that. There's complete trust. there was a grounding in, say, Midwestern values. I think of that as integrity. They each had fathers they admired who had spent a good deal of time in public service, one a congressman, one a federal judge. They both grew up in Omaha. They lived a, I say, understated lifestyle. Warren and Charlie both had big developed accounting capabilities. They both read all the financials, knew them well, but they didn't buy companies without an established record of consistent profits for 5 years or more, a leadership that they trusted with, that had integrity and had run companies that they were about to acquire. And one question Warren always asked was, is this person going to love the money more than he loves the business? Because Berkshire is about to make them very rich. And if they did, it wasn't a deal. If they loved the business more, that's who we want. And so it was a combination of risk assessment, but as I say, I think Charlie had a perspective that, and he was guided. He every great psychologist and knew all the biases that exist in judgment, and the enthusiasm of deal was more evident in Warren, but confirmation bias was something Charlie guarded against in everything he did.
And that was Ronald Olson, Berkshire Hathaway director, speaking, of course, with our own David Weston. And tonight on Wall Street Week, we'll hear from former U.S. Treasury Secretary Larry Summers, as well as Ruchir Sharma, Rockefeller International Chairman. That's at 6 p.m. New York time. This is Bloomberg.
From hours a day, Bloomberg.
News now. Seeing big moves. Next move. At 24/7 on the
News Now, context. There's a lot of we'll show you what's happening on Bloomberg.
Well, over the past 15 years, Morningstar has tracked 372 asset allocation multi-asset portfolios, and only one, the PIMCO Stocks Plus Long Duration Fund, has managed to beat the S&P 500 in that time. And joining us now, I am thrilled to say we have Mike Caldwell. He is PIMCO's Senior Bond Portfolio Manager. So let's talk about this fund. It's interesting because you don't hold the stocks themselves. You do it through derivatives.
Thanks for having me. The fund is part of our capital efficient suite. And what we do is we get the exposure to, in this case, the S&P 500 via derivatives. And we take the cash that isn't spent on equities, and we put that to work in fixed income markets. Fixed income markets will purchase U.S. Treasuries, investment-grade corporate credit, securitized products. So really, it's supposed to, the goal of the fund is to deliver the return of the S&P plus return of U.S. Treasuries over cash over full market cycles. And, we've had the benefit of U.S. Treasuries having a return over cash and being able to mimic the S&P 500. So the fund has done what it's meant to do, and we think over full market cycles, it will continue to out-deliver the returns of the S&P 500.
So I'm wondering, as a manager, how do you think about it? Like you said, it has the S&P exposure through derivatives. Of course, you use that to buy fixed income. What is the balance between those two asset classes?
Yeah, we like fixed income in general. We think fixed income is ballast in portfolios. It's a diversifier. It's a negatively correlated in times of declining inflation. And so if you just peel back the lens for a second, fixed income looks attractive from a return perspective, and it also has potential for capital appreciation. So you kind of get the best of both worlds. You get $2 of risk for $1 of money at work. And we think over time it's a more efficient way to build a portfolio that will be able to stand different market environments and market volatility.
And this, of course, is a long duration fund, and I'm so excited to have this conversation because everyone this morning has told me that it's not time to step out the yield curve, that you want to stay short, and if you're feeling exciting, maybe you go to the belly of the curve, but certainly go long. How are you thinking about duration risk in this environment?
Yes. Great question. And cash has been king. Cash returns 5.25%. Very, very attractive is a part of a portfolio. Having said that puts you at reinvestment risk. And, we think we're closer to Fed will begin lowering rates. We think they'll lower rates sometime this year, maybe once, maybe twice, depending on, how the economy turns out. But we think it is time to extending duration. Depending on portfolio needs and diversification, it will depend on how much duration you add to portfolios. We do like the belly of the yield curve. We think, we find that effective. We find that you'll have some of the benefits of capital appreciation while still holding hands with the Federal Reserve. So we do like the belly of the yield curve. We find that more attractive than the back end of the yield curve, but the yield curve offers its own type of diversification. It offers diversification benefits if you have some kind of disinflationary environment where yields really start to decline. You get some meaningful capital appreciation. Again, it's just, over the last week, we've had a 35-40 basis point rally that's led to a 6%, capital appreciation in a very short period of time in long duration bonds. They do have their place in a portfolio. We think now more than ever they'll have that diversification benefit, especially given what the Federal Reserve has told us is that they'll respond to in the road, they'll respond to wobbles in the economy and wobbles in the unemployment rates, and that should benefit fixed income and longer duration assets.
And Mike, we're talking about duration risk here, but let's talk about credit risk. I had a conversation with Jay Pulaski earlier this morning, and he said, don't even bother with the U.S. Treasury. At 4.2% on a 10-year Treasury, not too exciting. It's worth looking elsewhere into the corporate credit space, for example. Where are you finding the opportunities within fixed income?
So yeah, look, first of all, fixed income is quite attractive, but within fixed income, we find securitized products very attractive. So agency mortgage-backed securities, AAA CMBS, these are assets that are securitized senior up the capital structure. In terms of generic investment-grade corporate credit, again, we find securitized products more attractive. The spreads on offer in corporate credit are not all that attractive. Within corporate credit opportunities, we do like senior financials, we like utilities, but as a we'd much rather express that view in securitized products, again, where we remain liquid within corporate credit, where you can add yield to portfolio and add resilience. So we'd push back on little bit, and if you can diversify, securitized products are an asset we find more attractive.
Well, you touched on where I was wanting to go, and I have less than a minute left with you, but listening to you talk, pretty bullish and for good reason. But what don't you like right now, Mike?
So we find less attractive are, kind of floating rate assets, those that are exposed. This rollover risk, this higher rates in a time where the slowing. So a little bit less excited about, some of the corporate that have to deal with these higher interest rates, and also still cautious on commercial rate and the office market in particular. I think that's a long fuse. There'll be plenty of opportunities, but being very selective and very cautious in those areas right now. All
right, really interesting because floating rates have trade for so long, but maybe the time has run out there. Mike, really appreciate your time. Have a great weekend. That, of course, is Mike Kudsill of PIMCO. Now coming up, Carolyn Childer. She is Chief Co-Founder and CEO. She joins Bloomberg Technology coming up next. But that does it for Bloomberg Markets. I'm Katie Reifeld, and this is Bloomberg.
Years ago to move to the U.S. If you stay being so what our company people's talent. So the people can be passionate or what people's ability. Build. That's how we have.
In honor of Pride Month, Thursday in June at noon. Pride Month. From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
At Bloomberg's World Headquarters in New York.
And I'm Tim Stenivek in for Ed Ludlow. This is Bloomberg Technology.
Coming up, full reaction to shareholder meeting as the majority do back Musk's $56 billion pay package.
Plus, Adobe shares the company's sales outlook. How is AI driving demand?
And we head to the G7 meeting in Italy as the Pope warns on artificial intelligence. But first, let's check in on these markets. And it's a day where some lackluster economic data here in the US when it comes to consumer sentiment really dials in and ratchets up some of the risk-off concerns that we've got happening in Europe at the moment as we worry about the French political situation. NASDAQ flat, we're holding up relatively well, just down by some 3 points. The S&P fared a little bit worse, and we're seeing the CAC 40 absolutely slump at the moment. I'm ashamed I can't bring you a percentage on it, but in fact we've wiped out about $200 billion worth of market capitalization throughout the week in France. That's basically the size of the Greek economy. All gone. Why? Because we are worrying about the political situation, on about what that might mean for France, even in the EU. A lot being dissected in Europe at the moment, and indeed situation there too. I'm looking at euro just off by 0.5% almost. Let's move on and have a look what's happening in the sphere though, because look, it's not risk off everywhere, and actually we're seeing Bitcoin managing to steady at about 0.4% high. Small moves for a relatively volatile asset class, but we're still only at 66,937. Maybe a bit of a back in what has been never-ending money moving into some of these ETFs. But Tim, what are you watching?
I'm watching shares of Adobe, and there is no dial back going on there. Look at this. Shares having their best day, going all the way back to 2020. This after the company did report earnings after the bell yesterday that said that they beat on the top line, they beat on the bottom line, they raised their profit forecast for the fifth year as well. But it's this one metric that has everybody really excited. Digital media net new annual revenue. Projections for that part of the business did come in above estimates for the current quarter. We're going to have much more on Adobe coming up a little later in the program. And I do also want to check in on what's going on with shares of Tesla today, because it is the day after that shareholder meeting, and it is official that $56 billion pay package was by shareholders. We also saw the company shareholders vote on approving incorporation to the state of Texas from Delaware. That move actually already happening, according to paperwork filed after the meeting. Also, some board news coming out of the meeting. We saw Elon Musk's little brother, Kimball Musk, get reelected to the board, James Murdoch as well. Still, shares of Tesla lower on the day today and down about 28% so far this year. Well, earlier today, we heard from ARK Invest's Tasha Keeney on that package.
You have to look at the Tesla results here, right? I mean, when you're talking about the pay package, that has risen over 1,000% over that time period. So he's really delivered shareholder value. And again, so excited for the future because we're really on the cusp of autonomous driving today.
For more, let's bring in Bloomberg's Max Shafton. He's here in our studios in New York. So Max, I want to start with that pay package. Look, largely symbolic. We've talked about this a lot over the last couple of weeks. But 72% approval, I mean, it's showing that Elon Musk has the support of shareholders.
Absolutely. We've talked about all the challenges, all the craziness around Elon Musk, and at the end of the day, the difference in this vote versus the one that happened in 2018, just 1 percentage point. So it doesn't appear that Elon Musk has lost some huge constituency of support. I do think the conditions have changed to some extent, and there are the reasons for concern remain, but certainly this was a victory lap for Elon Musk, and he acted like it.
Hot damn, I love you guys, is how he jumped onto stage. There were crescendos of calling out his name overall. Look, he was being playful throughout the entire event as well. He was on Elon.
Look, this is a company that has a huge retail shareholder base. Elon is a business celebrity, and the annual meetings are always sort of rock star affairs, but it was maybe a tiny bit looser, and you did feel like maybe that there had been some stress building up within the company that was suddenly released yesterday afternoon.
Okay, relieving of stress. But then he went back to the bread and butter that is autonomous, back to robotics. I just want to go back to Tasha Keeney was saying over at ARK Invest a little bit earlier. Let's just listen to what she had to say about FSD.
I think this could have very attractive margins, higher margins than the current business model today, which is mainly selling vehicles.
Okay, so is it reality?
Well, I mean, we heard Elon Musk echo this and in fact bring up ARK Invest over and over again in that presentation. They just put out a huge, prediction for their valuation. Elon Musk really likes it.
No way.
Yeah, I think there is a question of what is reality, I suppose. On one hand, Elon Musk is going to say, Tesla fans, bulls are going to say, we have the best driver assistance system on the market. And if you just follow the straight line, Elon Musk said this, if you just look at the trends autonomy, we're going to get there. On the other hand, there is no robotaxi today, and there really is no way to get a robotaxi in the way that most people understand that word anytime soon. It's going to require massive regulatory overhaul and tons of technological breakthroughs that frankly are not there yet. And Elon Musk is counting on both of those things happening. Now, who knows? He has achieved a lot in his career, but this is a huge jump. He referred to, we're not just writing a new chapter, we're starting a new book. And look, starting a new book, that is a challenge. That is not a given, and it is going to be a real trial for Tesla going forward.
I'm wondering about new vehicles in that book. There was this little tease where there were sort of silhouettes of vehicles under white sheets. An image of that appeared. You think one of those vehicles, in fact, a very cheap EV that could compete globally with those $10,000 Chinese EVs?
I mean, that is certainly what Tesla's investors, at least some investors, would like to hear. And we saw a panic earlier in the year when it appeared that Elon Musk was backing away from that. I don't think we should look at that slide and say that Elon Musk has a $25,000 EV in the near term. He brought this up in all sorts of ways. He talked about how hard it is to get to affordability, how difficult the car business is. And of course, he talked on and on and on about robotaxis. For him, I think, at least right now, the affordable Tesla is the Model 3. He talked about how cheap it is with all their incentives, when you consider the cost of gas and so on. And where they're really pushing towards is robotaxis and of course, Optimus, which if you think a robotaxi is a fanciful product, Optimus is, sci-fi or something.
Sci-fi. Well, he's pretty good at sci-fi overall. We thank you, Max Trafkin. Absolutely brilliant to have you here to talk about some of the light moments within what, of course, was that AGM. But there were some serious moments, and one of them was being voiced by Kristen Hull, CEO of Near Impact Capital, the co-filer of Proposal 8 regarding annual reporting on anti-harassment and discrimination efforts over at Tesla. And Kristen, you're a renowned sort of activist investor. You go out there wanting impact. When you see this ultimate referendum endorsing Elon Musk and his board, you're having the impact?
Hello, and thanks for having me today. This is a good question because we're here for the long game. We had been long-term investors in Tesla, and we certainly see the promise, both of the AI, of the robotics, but certainly about revolutionary the entire automobile industry. And yet, being at the meeting yesterday had us concerned about where investors are with this company.
That Proposal 8 that Caroline just mentioned was voted down by shareholders yesterday. So I'm wondering where you go from here, given that you were one of the sponsors, the ones who brought that to the attention of shareholders. What's your next move, Kristen?
We don't have the numbers yet, and so I'll be really curious to see how many of the investors actually did support the board doing a report looking into how much the company is spending on discrimination and harassment issues. Of course, for this company, Elon said himself several times, he is a pathological optimist, and to be that optimist and to get the dreams and the promises he made to shareholders, he's going to need to have some really top talent at that company. So to be able to hire and retain that top talent, they're going to need to spend some money and some time and attention on human capital management.
You say within that speech that you gave yesterday, you worry about the human capital management, the workforce management. Year over year, you're saying more harassment and discrimination allegations have emerged with few changes to Tesla's people management policies or practices. And in fact, Kristen, I just want to add to the fact that in a context where we're not just talking about this with one company of Elon Musk's, we're talking about it with others. Just SpaceX and fired engineers there this week filing a lawsuit against Elon Musk's sexual harassment and for retaliation over in California. Kristen, how much is this a worry, you think, more broadly?
This is a significant concern. There are thousands of employees that are coming forward. And this is, as you mentioned, this isn't across one company. He is the leader of several companies